Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets, from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Karl. It's great to have you back on the podcast. I think you were one of my earliest guests when we first launched the podcast back in the height of COVID in 2020.
Yeah, not counting, but I think I was number 2.
Yeah. And it was thanks to you being in such an excellent guest that it kind of gave me the motivation to continue. And we've been going for 2 years, and we've had hundreds and thousands of downloads. Thanks for being one of the early guests.
It's my pleasure. I actually enlightened self-interest because I listen to it all the time, and some guests I find what they're saying more interesting than others, but I find it. Most people have thinking differently from the way I'm thinking most of the time, which is either worrying or reassuring. I'm not quite sure, but the interesting thing is that you have just kept going. I think that's a fantastic achievement. Anyway,
I appreciate that. Yeah,
I won't give you a round of applause, or maybe a small one, but to keep going, and funnily enough. When you sent me, a request to say, advice you would give to younger people, one of the things that I put, in fact, the thing I put is always turn up.
Yeah.
And it's we're going to talk about ideas, and I guess most people who are watching this are good critical thinkers, and even the bad ones, they're at least thinking. But the most important thing to anything is just turn up, be yourself. Show integrity, keep going. And I know it does sound very old-fashioned, but it's you only learn that from having been around a long time. You and I have been going for a lot more than 25 years, right? So just keep going, everybody. Good luck.
Yeah, no, that's great advice. And actually, while we're on the subject of keep going, I don't think I asked you before what your origin story was. I don't think we went into much detail. So perhaps we can start with that. What did you study at university? Was it inevitable you'd end up in finance? And what's been your journey up until now?
The most dangerous thing to ask any male trader is to talk about themselves, but I'll keep it quick. So I did the usual sort of A-level maths, physics, chemistry, and then I ended up going to Imperial doing physics, but I hadn't really finished there. I didn't really. It didn't really complete my interest. So I was lucky enough to get a DPhil place at Oxford, where I didn't complete, in fact. I did submit, but I needed to do some extra work. I ended up moving to JPMorgan before I completed my DPhil, funnily enough. And that was quite some time ago. It was just after one of the major crashes in 87. I enjoyed my time at JPMorgan, but one of the things that I have learned subsequently, when I look back, what did I learn? It's very difficult to do different things at the same institution. And if you're interested in many things, unfortunately, that's one of my faults. If you want to change focus, you practically always have to change the institution. So since I'm interested in lots of different things, I've worked at 7 different places in, 34 years. So maybe that's not too many. But it's meant that I've always been able to be looking at really interesting things, for 3 or 4 years before maybe I move on to do something else. So I would say the first third of my career was in market making and bonds. And then, second third was in sort of bank treasury and hedge funds, much more proprietary trading, and really the last third has been sort of long term, more sort of investing in / hedging of risks, long term, but much more long term risks. So if there was one characteristic you could say is I've slipped down the slippery slope of illiquidity, I've got more and more strategic, not because I think that's really important, but because it just happened. Trading and tactical trading is a young person's game. It's like a nice light in a phone box. And I think after a certain point in time, you can't add very much value, even if you are experienced. So I think you add much more value as you get more experienced with more strategic things. So I'm not sure if that's always true, but it may be true in my case.
Yeah, no. That's well said. And in our sort of regular conversations, you always bring up interesting ways of looking at the world. And one thing that struck me in our recent conversation is you talked to me about incomeism. And perhaps you can tell us, explain more to me and the audience what you mean by that and what it contrasts with.
Yes, I was asked to give a talk. It would be more than 10 years now, 2010. And I was invited to give a talk on any topic I liked. It was in this particular place called the Athenaeum Club in London. And I thought, well, I can't just turn up there and talk about markets. No one's interested. So why don't I just talk about the way things are in the markets, but not what's going on in them, because I don't think anyone cares. And the more I started to draw up notes for what I was going to say, I realized I was actually saying something very, very specific. I wasn't just telling them about conditions and risks and things, which is my particular enthusiasm. I was actually coming to a conclusion without realizing it. And the conclusion I was coming to is because I'd just been doing a lot of work at that time. 12 years ago, looking at a lot of demographics was probably seen as something of a peculiar thing to do for a macro trader. But I think it's in the back of most of our minds, but I just don't know why. I've been reading a lot of stuff. I'm friends with a fellow called George Magnus, and I think he was in the process of writing a book called The Age of Aging. So I'd been talking to him about it, and I come to the conclusion that actually we were going to see some very major changes in this thing called the dependency ratio, which is, I think most people are now familiar with that, which is how many people are dependent upon the people who are really earning money. So you have this, in our lives, we all know it. There's a sequence in your life between, let's call it 18 and let's call it 50, 55, when you're earning all your money. But before then and after then, you're drawing down money. It's either your own or somebody else's. So you're a dependent. And that ratio between those two people is a really good measure of all sorts of things that happen. I seem to recall reading a paper that said it was very highly correlated to real GDP. Now, I'm not an economist, so let's stop that conversation right here. But I just thought that's interesting. I thought about it in terms of being a physicist or ex-physicist, and I thought, well, people and their behavior, it's like the energy in a system. We have this closed system, total population, and within it, we have all these constraints. And, when more energy gets into the system, it's in that cohort. And then I was looking, so I'm coming to the point. I was looking at this and I was thinking, it seems that capitalism seems to be highly correlated with this dependency ratio moving in one direction. In other words, when there are more people out there looking to earn money, they're also looking to invest their money. And is it a coincidence? Maybe it is. Someone will tell me that as we saw this rise in that cohort going through the population of most of the let's call it the G10, G20 OECD countries, most of them at the same time, you also saw the rise of capitalism, as we would like to call it. I suppose not even post-Plaza Accord, but post-Bretton Woods, really, the dependency ratio has been moving in the same direction for most economies, almost in one direction up until about 2010, which is when I was making this talk. And then I was aware that the predictions for dependency ratio in the next 10 to 15 years, so now and the next 20 years, were that we would see these sharp moves reversing away. So I thought, well, if we had capitalism when the dependency ratio moved in one direction, what happens if we don't have an excess of people earning money? And I was just, like I said, I'm not an economist. And I thought, well, what would be the opposite of capitalism? And I thought, well, maybe that would be called incomeism. And maybe in capitalism, people are concerned with returns and fear of missing out. And in incomeism, people are concerned with the ways in which they can lose money. And what would lose them the most if income was their principal concern? I thought, that would be inflation. So 10 years ago, I said, in about 10 years, it's on the record, in about 10 years, we're probably going to have some problems with inflation just because of the way the dependency ratio is working. And it will be different in different economies. And I have no idea how that could happen. And as we all know, core CPI in somewhere like Europe has been 1% for, since then, hasn't it? 1% until this year, until starting 2021. And now we seem to have flipped into a core of 4%. Now, you could find all sorts of reasons why that's the case. And I'm sure demographics is only one, but it is one of them. And it was foreseeable. So incomeism for me is a clearly a made up portmanteau word. I've not seen a definition of it in a dictionary.
That's a really interesting idea. I mean, so what you're kind of in essence saying is that when you're in this phase where there's lots of working age people in a population, so there are less dependents, then it almost is associated or necessarily leads to this kind of growth mentality. People want to jump onto things that are growing, and there's excess capital looking for different opportunities. But when that starts to shift and you get more dependence, especially, I guess, in the case of the West, there would be aging populations, then people start to think, hang on, we need to worry about our incomes, and it becomes more sort of defensive, cautious. And as you say, the biggest problem then is inflation. And it wasn't a problem, inflation.
It could be.
And now suddenly you do. So if you have incomeism and inflation, that's a toxic mix.
It is. And of course, look, I'm the first to say, traders who learn economics on the desk, right? You're your own worst enemy. I suppose what we learn as risk takers on desks is that we learn to interpret data, but we don't necessarily understand how it works. And in the same way, I don't need to know how a television. I used to argue this. I don't need to know how a television works now to switch it to channel 4. You know what I mean? And that's really part of it. However, in this particular instance, I suppose it was the confluence of having been around at that point, 20, 25 years or so, is that I started to actually believe that what I was saying seemed sensible to me. But more important than the thing about incomeism or capitalism is I suppose what I was trying to do is I was trying to get information. I was trying to interpret it within the constraints of what I understood. I mean, this is clearly a sensible mental framework. And actually the scientific method, which is the way I've been trained, it is, after all, only 4 words. If I may share, I mean, it's very straightforward. The whole of science is 4 words. Anything more than this is a specialty, right? The 4 words are you theorize, you measure, you compare, and then you repeat. And that's it. That's the full fruit basket, right? That's all there is. Everything else is just specialty things. And I think this is the thing that we've been talking recently, and the whole time we talk about, is we're always trying to compare the constraints that we see, conditions that we're trying to interpret, not what's going to happen next, but what the conditions are, what they will allow to happen. And, I think you and I both know, we suspect that some strange things are in play. And the reason why we suspect that is not because you get paid to be paranoid as a macro trader. You probably do a little bit, but actually you get paid to find out when things don't make sense. Most people that I'm aware make more money when they spot discontinuities and a lack of market logic in either policy or markets than they do by saying is, oh yeah, the market's absolutely right, I'll just go with that. We leave that to maybe to the trend traders, a certain type of investor.
I mean, one thing I wanted to touch on then is when I speak to lots of investors and we talk about, okay, we're in this new regime, higher inflation, central banks are raising rates. And then we start to talk about, okay, what's going to break in the system? Something surely should break. There'll be some fragility somewhere. But then people start to go through the list and think, hang on, okay, household balance sheets look okay. Corporate balance sheets look okay. We don't have a housing bubble like the GFC period. The China bubble is slowly deflating. So, people can't quite point to where the big blow up will happen.
Yes.
And so let me put that to you then.
Yeah.
But how would you respond to that?
I think that is very logical and very sensible. And I think for the last certainly 40 years since the Plaza Accord, and if not since the Plaza Accord, then definitely since the ending of the Cold War, then we've seen markets, whether they've been volatile or not volatile, in a so-called crisis or not a so-called crisis, they have actually behaved in a very, very similar way. Mean reversion has been a play. People's characteristic investment behavior has been persistent, and obviously there have been different regimes. There have been inflation regimes, non-inflation regimes. But the one thing that hasn't been is there really hasn't been a lot of the main drivers of what drives capitalism going wrong at the same time. Right? That's what we've not had. Now I'm not saying. See, I guess my principal issue here is it's very easy as an Africa trader to always believe that now is the best time ever to buy vol. Right? It always seems that way. I think this is much more fundamental than that where we are at the moment. For what it's worth, I think there's a big difference, and people will recognize this argument. There's a huge difference between uncertainty and risk. Right. So risk is something you can measure and maybe anticipate, and then you sort of understand the outcome that happens afterwards. But uncertainty is where you really don't understand what's going on. You really don't understand what model to use, and then you're not actually sure when it's over. So not only but the variables, but the timing of the thing is uncertain. You can't even say whether this is a little bit like COVID was very much a uncertainty versus risk. There was a risk of a pandemic, but then once COVID happened, there was the uncertainty about the virus. So they're quite different things. So when I look at what we're seeing at the moment, and I see when I'm speaking to many people who I know, is that we all seem to be recognizing there seems to be a sort of quickening going on. But it's not a quickening in good vol. It's a quickening in how quickly the markets can flip conditions. I mean, dramatically flip conditions. And you might say, well, that's because we're at the end of a cycle, which is a reasonable argument. Or maybe there's uncertainty in how central bankers or politicians, maybe we've got particularly weak central bankers and politicians, arguable. I don't know about that. But really, the thing that I'm worried about is the thing that happens next, if you like. And it's this. The one thing that hasn't really changed is the correlation between asset classes. Because I think that's the next derivative on. When we clearly have very complex markets now, incredibly complex on all sorts of timescales and all sorts of characteristics. Now, one of the things that they're doing a bit of physics and a bit of maths has enabled me to do, and maybe the reading I've done since I did that, is the appreciation that there are these characteristics. I don't want to be too nerdy about it because actually I don't know the full details. I just know something about it. There's this concept of the strange attractor where complexity can lead to transition between different equilibria. The best example most people use, I think it's actually I'll use it too, is that you can have something which is a totally known system and measured. Like the circulation of various bits of iron on the Earth's surface. And every however long it is, I think it's 30,000 years or something like that, maybe 50,000, there's a flip in north to south. And that flip in north to south, and then we stay there for 50,000 years, and then we flip again. Now, nobody's saying that something totally uncertain is going on there, but we know it's going to happen. We're not quite sure when. The transition is very, very quick. And then we're in an entirely new equilibrium. North is south and south is north. Now, I have a very funny feeling that we haven't seen anything like that in financial markets. I'm not sure whether that means we're going to an inflation environment, or much more worrying is that we're going into an environment where correlations are going to flip a lot, and that we're going to see a rise in things which are going to be difficult to put on a spreadsheet. Does that make sense? It's a sort of...
it does. Yeah. I mean, there's a few things I'll just kind of, I guess, raise. One is in terms of like changes in system or phase transitions. I suppose COVID and also perhaps the lockdowns associated with COVID were such a transition from what we used to. Nobody would have anticipated that, governments would force people to, go under effectively house arrest for some period of time. I mean, that just was completely out of our imagination, and that did happen. So I can see something there. The question I suppose I have is, could you not have made a similar argument about this kind of flip in conditions after the global financial crisis? Because that also felt like something quite tectonic, and
yes,
correlations flipping and the whole system under attack, and something dramatic happening.
I think most people did. But what we didn't know at the time was that, and I think people are still writing books, and we can still disagree with what actually happened on a day-to-day basis with the GFC. I think I've read 4 different books with 4 entirely different versions, which absolutely do not correspond with my version. Goes with when the Koreans raised interest rates, and nobody seems to mention that. That's when LIBOR started to move, and I was trading a lot of the basis at the time. And I said, well, there's a shortage of dollars, off we go. I thought it was that simple.
When was that? When was the Korean raising rates?
If you look at the day that that LIBOR was trading around, that we were trading Eurodollars at, very close to LIBOR, flat, whatever it was, flattish. And then the next thing everything was trading at LIBOR plus 100 or something. Yeah. It was the day after. I always remember thinking, again, this is the problem with not being an economist, but being an empiricist. I just remember it happened the day after the Koreans raised rates. So for me, I always remember that. And then I try and go back and backfill like most people do, and probably wrongly. But this is what we didn't know, right? What we didn't know, the GFC, is it really was a little local difficulty, right? We hadn't seen a massive flip in the number of people buying goods versus services. We didn't have huge problems with transportation. We didn't have a geopolitical, sort of a geopolitically inflamed world where, if you like, the China side of things and the US side of things were sort of against each other. We didn't have certain types of weaknesses in euro. And what we did have is we had all the central banks all at once adding energy to the system in a physics sense, which is liquidity. The ultimate energy to economics is central bank-based liquidity, I would say. That's what we found out now. Now what seems to have happened is that, again, using the physics analogy, is that we seem to have occupied every single condition that can be occupied. Every single investment that can be made seems to be made. Every VC that can be VC. Is it possible that all of them have been occupied? Well, no, but just a gigantic proportion of all possible outcomes have actually been filled by the possibly inappropriate allocation of capital that goes with QE and ZERP.
No, that's a very good point, actually. So in essence, what you're saying is that what happened around GFC was that, or the response to it was, number one, there was a huge amount of energy or liquidity added to the system, which kind of stabilizes the system. And also at the same time, there wasn't this huge disruption in the real economy or geopolitics. No, so in some ways, the direction of travel was almost stabilizing. Today, you have the opposite, where suddenly central banks are taking liquidity away. Yes. And the fundamental structure of the real economy globally seems to be changing. The supply side is changing massively as geopolitical tension. So it questions the very economic model that we all assume would remain with us for the rest of our lives. I'm going to apologize. I'm not an economist. I'm an empirical economist. But I wrote a thing back in 2014. I shared it with a mate the other day. I actually wrote it down. Got the actual date on it. Dated. I didn't make any changes. And I just said, the thing about the GFC was, for what it's worth, is that it really was a liability crisis. It really was about. It really wasn't about people defaulting. It was about solvency, and it was about liabilities. It was about making short-term payments soon,
And everybody thought, oh, well, if we can't make those payments, we're going to go bust. But when you add a liability crisis to a very heavy leverage, which is what really was the part of the problem, what is the one thing that central banks can fix? Is they can fix getting money to you now really easily. In other words, central banks are the best possible way of fixing a liability crisis. But liability crises are short, they're sharp, this is the characteristic. And then they're fixed quickly, and then they recover. That's a liability crisis. Now, QE, I think we were pumping money into the system way too long with QE. The liability crisis was already over, but the market just became accustomed to it. What we have now is slightly off piece from what we were talking about before, but I think what we have now is more like an asset crisis. And I'm not really sure. In other words, the valuation of many assets, many people disagree with all sorts of assets. Now, that's always the case. We disagree with most things. That's the markets, right? But the one thing that central banks are really poor at doing is actually telling people how much to pay for Tesla or how much Amazon is worth or what. They're no good at that. So what happens is those zero interest rates, they flood inappropriately into the wrong assets because, the expectation with the dot plots is that rates would stay low for a long time. People have inappropriate certainty about the future, and they invest that way. And you know what? Let's face it, up until very, 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 very recently, that has worked tremendously well. But that's not to say that we can't see an incredible flip incredibly quickly. And of course, one of the reasons why that's happened is inflation. It's suddenly that inflation is a real risk. But inflation's there for the same reason why, the markets could have a problem. Not just the markets, but the economies could have a problem here. Is that we have many things going wrong at the same time. We have, personally, arguably, you could say that weaponizing central bank balance sheets is sort of quite dangerous. We know why that happened. Not sure how it's worked, but we know why it's been done. We've seen problems with supply chains. That was never anticipated. How could that ever happen? And that's because there's massive flip between services and goods. For all the reasons why people, buy an extra guitar when they're sitting at home. Guilty. Then did we think that we'd have stability in politics and geopolitics? Yes, that seems to have gone away as well. So really, all of these things are going. All these things are they're not going wrong. That's not right. They're being challenged all at once. And that's very different from the GFC. So it's not a liability crisis, it's an asset crisis. All the conditions or many of the conditions for capital are under the microscope or telescope. Actually, some of them are so far away now. And so we're in a different environment. And I think, therefore, to say that this is very similar to what happened post-GFC or post-87 or post the Brady bond crisis, I think it's very dangerous. Those were very specific set issues, had their very specific set problems, but they were little storms in an ocean, in a calm ocean. They were like in some port over there or some port here. But that's not where we are at the moment, in my opinion.
And when I listen to you, it makes me just want to sell all assets or expect all assets to go down and go into cash and just stay on the sidelines.
Well, here's the thing. There's only one way that you could feel that way. And I would suggest if you were 20 now, you would probably you could listen to everything that we were discussing and go, this is a magical world of opportunity. Because it's only when I see excess returns can I get to the point that I need to get to. Whereas maybe you and I, closer to a different age, let's leave it like that, we're much more concerned with the conservation of the assets that we built up or anything that we have. We don't want that to go away. We can't afford to take that risk. Now, here's the problem, is that the demographics in the world are that there are many, many more of you and I, Bilal, than there are people 20 or 30 and under. Many, many more. And in fact, even if you were to just take a snapshot and say, just for the sake of giving an idea of scale, the average age of a person in Japan is now 50. 50, that's the average age. The average age of a person in the UK is 40. Now, I'm sure we can find a country where the average age is 30, but there aren't many. And the demographic, these dependency ratios are shooting up. And so here's the danger, is that throughout all of those other considerations, what happens if it's just as simple as we might be running out of taxpayers? Right. You see what I'm saying? I mean, unless, of course, this is the way the people who are sort of anti the demographic observations, quite right. And why wouldn't you always look at anybody's theory and poo-poo it and say, yes, but there's another way of looking at it. And there is. You basically tell people that they've got to work till they're 75. Now, I think that's where we're going. For example, when the National Health Service was set up in the UK, way back in, what was it, the late 40s or something like that, the average age at which people died was 69. And you could start claiming your pension when 65. Right? So spot the difference now. You can start claiming when you're 67, but you're not going to die, if you're lucky, until you're somewhere between 80 and 85. So it was never, ever, and I know the different components of the National Health Service are very different. But remember, it was just set up to make sure that people, when they retired, because there were many more people in those days doing manual work, they didn't just drop off. They just didn't drop their clogs. But most of them did. Most people died quite quickly. The National Health Service couldn't do anything for you. And it didn't really have to expend a dramatic amount of resources. That's not where we are now. We redefine the way the National Health Service works. I've been the beneficiary. I'm sure you have, or everybody who has children has been. Practically everybody that will ever watch this will have someone who's been ill, and we're intensely grateful for it. But it was never designed to support loads and loads of old people for 20 years. And that's what's happened now. So when I look at the economy, again, it does relate to the same issue. The economy and the way that capitalism has grown has been on this flood of excess capital that's been demanded from people who are making excess savings, excess returns. And that river, I mean, some rivers, very few, can actually not just change course, but reverse course. What happens if the flood is coming the other direction? That's what worries me a little bit about what's going on at the moment in terms of we see the big move in 60-40 in the first half of this year.
The 60-40, just to be clear for people, is just the asset allocations. People allocating 60% to equities, 40% to bonds. Yeah. Historically, last 20, 30 years has done fantastically well. The bond yields have fallen, equities have gone up. But this year, both sides collapsed. Both sides.
That's right. And of course, the statistics of uncertainty, the statistic of anything is that, of course, this is a wing event. But one of the this is why I want to sort of discuss with you, Bilal, is that what happens if it's not a wing event? I'm not saying it's going to get worse, but what happens if we just don't go back to the mean reversion assumptions that we have had all of the great 60-40 returns we expect to make on aggregate? We will see a distribution of them, but what happens if instead of the distribution being built around plus 10%, that distribution is now built at -5. Now, okay, at the moment, I think we got to -20 at some point or something crazy like that. I'm not saying it's going to stay there. That probably is a gigantic amount of people getting out of all sorts of excess risk. But it is possible that we could see a new equilibrium built about an entirely different mean. That's always a risk. But the reason why it might be right this time is that many of the things that have driven it there have just not gone away.
I mean, when you describe the coming healthcare costs, the retirement pension crisis, it does seem like there just aren't enough productive workers to sustain the system as it currently is. So something has to give.
Well, and the reason why there are all sorts of solutions to these things. Of course, you could increase taxes. Unpopular, right? Obviously, you could get people to work for longer. But then, I think one of the things that disturbs me, my children are in their early 20s, is, I'm aware of just how high, undergraduate and young people in general unemployment is all around the world. So it's very, 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 very high. Can you imagine a set of circumstances where a government says, well, I know you're not going to like it, but we are not going to pay you at 65. We're going to have to pay you at 75. Well, I don't know many pensioners who are going to go, oh, yeah, that's fine. I've got loads of money. No, they don't. And if you do that, you're forcing people, you are unretiring people. And if you're unretiring people, and specifically you're unretiring people who are, many of them on low incomes, you are definitely forcing them into what tends to be younger people's starter jobs. Right. That's where I think now that's where we could have very significant social issues. And I think we're starting to see them now. The identity politics is very largely based upon the behavior of younger people. Lots of people want to know why that is. I don't know, but I have a guess. I think it's just about taking control. I mean, if you don't have necessarily very good outcomes economically, and much of what happens to people who are in some way disadvantaged is economic, then really, what do you have control over? You don't have any control over your economic security. You do have control over your own personal definitions. And that's the one thing you have control over. And I'm sure I'd be as woke as the next person if I was a younger person and I had no economic control. I'm sure I'd feel that was a way of reflecting that. So I can understand it entirely. That's why it's one of the things why for many older people, it is so mysterious, because they can't imagine what it's like to have no economic control. And to pick another way of looking at things. Now, I know we didn't want to go there, but we don't necessarily want to go there. But I think it's just a reflection of a similar risk.
Yeah, I mean, what comes to mind is, in the 60s and 70s, there was lots of kind of social revolutions going on, and whether it was in terms of feminism or whether it was like drug culture or hippie movements and so on, and then there was kind of the left versus right. And so the question is today, what if you do want to fight against the man, stick it to the man, how do you do that? And that's right. It's the whole identity politics, wokeism, that's the new kind of way of
personal identity. Yeah. Personal identity. It's what you truly do have control over. And I can totally understand that. I can totally understand. And anyway, moving on. I think so. This is one of the characteristics of where we see things. So, there was a. I wanted to raise this actually with you. I don't know if I've ever mentioned it to you, but there's this really interesting book. If anyone's interested in reading it, I'm not even sure if it's in print anymore. Called The Upside of Down. And I remember I read this in 2006, just before the crisis happened. It was very handy because it's a great guideline. If you read the book, if you imagine, I mean, I'm not being funny, but the advantage I had reading this book just before the crisis happened, it was very, very handy. And the guy who wrote this, he's a Canadian academic called Thomas Homer Dixon, and he came to this conclusion. Now, this is 2006, so quite a long time ago, but it seems to have, there's an echo now, and his thesis is that complexity leads to fragility in systems. And the reason, this is how he gets there, it's quite clever, I think. I mean, he says that, complexity leads to specialization because it means that everybody has to have a very specific job. I don't need to grow potatoes. There's a man who grows potatoes. There's somebody who makes shoelaces. So complexity, especially in social systems, leads to specialization. But in the end, you end up having so much specialization. There's not enough redundancy in it. The system is so fragile to anything going on. There's no overbuilding of safety margins in anything anymore. And as long as systems stay in equilibrium, they flourish because everything always makes sense. People make brown bootlaces, and then people want to make blue ones, and then pink ones, and flowery ones. So everything gets more and more complex. But something always happens in complex systems, which drives equilibrium just a tiny bit away from where it was before. And often it's just a mathematical artifact. And when that happens, these systems fail. And this upside of down thesis, he actually comes up with this great word called catagenesis. Have you heard that word before?
No.
I don't. No, either have I. I'm not even sure if it's in the dictionary, but it might just be a nice portmanteau word. But basically, it means the making of something new by breaking it down. I suppose catalysis and genesis, catagenesis. And I read this book, and I remember reading about self-organized criticality and pink noise and sand piles and all sort of stuff. And that suddenly was a really good training for what happened in 2008 and 9. And I guess I've never really forgotten it. And it seems to me that we just have a much bigger sand pile now. Does that make sense?
Yeah.
It used to be a small sand pile at critical level, and it collapsed, and we had to build it all up again. And central bank energy, if you like, in liquidity, built everything up again. But now, I hate to be a cliche, but that won't stop me. But the biggest risks that we have are not directly in finance, but they are financial, right? They're financial consequences. And it does have to be demographics. It has to be climate. It has to be. Let's not talk about the weather. It does have to be climate. And if you really want to get a little bit recherche, I'm not saying it's a bad risk, but it is a risk, and that's machine learning. These are very new. These are very new. They've been around for a while, but they've not been influential. It's like we haven't got to a certain threshold, and these thresholds seem to be reached at the same time. That's what is a little bit concerning to me. This is not like, oh my God, sell the S&P. The way I'm coming at this, I'm saying, is that many of the different ways that we've all learned to do asset allocation and allocate assets and make sensible decisions for the markets, all that logic still exists. Of course it does. There's good and bad ways of approaching the markets, but one of the fundamentals is how turbulent are conditions. How do we spot turbulence? Because turbulence is bad vol, right? You can't make money from a turbulent market. You simply don't know where it's going. You can get lucky. You might even position for turbulence, but then you'll lose as much money when the turbulence is a collapse in vol as you made maybe in the massive spike in vol. So turbulence in correlations is the thing that's on my mind. So many of these factors are driving uncertainty, which are going to lead to more and more turbulence in financial outcomes.
I'll come back to that in a moment. I just want to pick up on the climate change comment that you made. How do you think about the climate change risk?
That's well.
I mean, it's a very open-ended, big question, but at what level? It seems like the projections are that in the next 50 years or so, we're going to have lots of more extreme weather patterns. Countries won't look like the way they did before. It'll have migrations, things, insurance costs will go up, the structure of the economy will change if we don't switch our energy source. Yeah. From an investment perspective, there's flows, the fossil fuel industry is being starved of capital. So there's some kind of near-term dynamic. So these are some of the things related to climate change. But how do you, what kind of sticks out for you?
First thing is, I think I wrote a podcast for you about this, about how I thought the problem with climate change is that it was categorized as a crisis, whereas that put people off. It stopped people from listening. People have heard about crises. They don't normally last and no one cares, right? But if you can encourage people to actually engage with things that they might be able to do, just for pure good stewardship, And, the 6P principle, proper planning prevents particularly poor performance. If you can just do that, then actually it's not a crisis, it's a challenge. It is definitely a challenge to sort this out. If you call it a crisis, every day or every week or every month or every year that it doesn't happen, as in some crisis event, people lose interest. And so a little bit like we were talking about, just keep turning up. They don't turn up to the argument anymore. So I think we need to classify climate change as a challenge and not a crisis, right? Because it's ongoing and it's going to last for quite some time. So if we approach it like that, then that means that we're going to need to think very carefully and take long-term actions. So the first thing is, so that's I suppose that's the way I categorize the way I look at it. The first thing is that really climate has become very distinct. Remember 10 years ago, if you'd have said green or environmental or climate or carbon, it would all sort of morph into the same sort of argument. Someone would be calling someone a tree hugger or, a whale botherer or something, but it's not like that anymore, right? I think climate is boiled down to decarbonization, and decarbonization is boiled down into one word, and we need to get this into our thick skulls, right? Climate is about electrification. It's about electrification. I'm not a big advocate of electric vehicles because for a variety of reasons, but electrification. We need to generate electricity in different ways. That's the power we need. Unless you want the global economy to shrink, we don't have a choice. We need energy. There are only two sources really in all economic theories, and that's people and energy. Now, we can't do much about the people, though demographics is giving us a bit of a problem there. But the energy associated with electrification means we really do need to think about things. So I look at the decarbonization of all the different sources. Of course, I cannot work out why people are so adverse to nuclear technology. I would say that. Maybe I'm a physicist. Not all physicists have that view, of course. But nuclear energy, obviously very important. And I also can't understand why we can't understand that since there's going to be a transition, just stopping coal, stopping gas, stopping these things during the transition is going to cause all sorts of turbulence. That's what's happening now. So I'm not saying, keep going with coal, keep burning coal. No, there's a period in which we have enough of the right sort of energy to enter the electrification system. And we're not there yet. So until we are, we need to keep certain types of fuels because we have access to them. And a large part of what's happened now is effectively we've been a little bit immature and we've decided to cut all these sources of energy. Now, I obviously understand there's been clearly a post-Ukraine event, but, the oil market was having trouble and the gas market was having trouble in 2021. That's why inflation was already going up. And one of the interesting things I've just learned relatively recently, and please, if anyone knows better, which is everybody, please correct me, is I understand that part of the problem with what's going on in the hydrocarbon business is just what was going on in refinery capacity. So people at the moment, of course, are saying, well, why is it, oil prices are falling, but the price of petrol or diesel hasn't fallen at all? Well, that's because the amount of money that the refineries are able to charge now, because there's a shortage of refinery capacity, is gigantic. It used to be something like $3 to $5 a barrel, roughly. And now it's like $30 to $50 a barrel. So even though oil prices are coming down, the gigantic refinery costs are actually preventing it coming back down the pipe to the people who are using it. Now, the reason why that's important to what we're talking about in general is it was an unexpected move. Why did refinery capacity become a problem? Well, because many of the ESG mandates were, and certainly public money, were saying you just simply can't invest in that sort of technology anymore. The oil companies are making decent money, but they don't have only that money to invest in refinery capacity. So to a certain extent, the certain aspects of the ESG that I would suggest that we call it the ESG, but really in this particular case, it's all EE, obviously. Prevented a sufficient amount of money going into keeping our supplies of relatively cheap energy resilient and robust. That has not happened. And now we're paying the prices that we seem to be, at the behest of somebody who we really don't want to have control over our outcomes. That's where we are.
So climate change, an important thing there is one can more narrowly define it now around decarbonization and electrification. So that's the filter through which one could see it. And there is right now this transition issue, which we're all kind of grappling with. So this is kind of the one way of looking at climate risk. The other thing you did talk about was machine learning. And is this the point about machine learning is becoming so good, it's going to replace people, and that's going to have an issue? What was it about machine learning?
I think machine learning has entered a lot more of our lives than we choose to recognize. Many of the financial decisions that we are able or authorized to take will go through machine learning processes. Many of the different ways that resources might be allocated, either in financial markets or in terms of your pension, might actually find their way through machine learning. Many of the ways that the banks fund themselves, maybe their bank treasuries will be optimizing bank balance sheets via machine learning algorithms. Now, what we don't seem to have at the moment is we're all aware that you can actually speak to these machine learning algorithms now, and they will understand what you're saying and give you an appropriate response. There are all sorts of different ways. It certainly feels that way every time you want to update your car insurance. You're speaking to a machine, but sometimes you are, by the way, right? So I think it's a really small but growing and not just growing, but it's broadening in terms of the sorts of expert systems that can be built. People look at machine learning and think, well, it's just numbers, isn't it? But well, actually, expert systems incorporate all sorts of concepts, including words and including anything that could be codified in any way can be built into an expert system, whether it's the interpretation of photographic images. Tax code? Why not tax code? Why not the legal code? If we could sufficiently, I think
it's a great point, Karl, because one of the things we're doing is we're using machine learning techniques to go through central bank documents. So in the past, what would have happened would be there'd be a person that would interpret and watch them release the beige book or Fed speeches. Now we have machines doing that for us, and they can do it very, very quickly, but also they can quantify it. You can contextualize it over history. So that removes kind of the biases that you have with people over the cycle and so on. So I certainly see it in terms of the research process with financial markets. This is just one small example, but I kind of echo what you're saying.
Well, if you can see it in your own world, I think the danger is you always say, well, yes, but it's only in my world, it's nowhere else. And then you speak to somebody else, go, actually, it's in my world as well, but nowhere else, obviously. I think it's more broader. Is it a problem? I don't think machine learning is a problem. And I'm sure there'll be many people who say, well, machine learning is an ultimate existential threat to knowledge learning, knowledge workers. No, it'll be there for very specific purposes where just gigantic rafts of data need to be interpreted. If you want to make it decide what book you want to read, well, I'll give you a clue. That's already happening when you log into Amazon. That's already happening when you go into Google. So, and since that's the way most people interact with the whole world full stop, it's already happening to everybody. It's already determining your outcomes and your purchases and your behaviors. So I just think it's the reason why it's a risk is I actually think the biggest risk is that you don't incorporate it and that somebody else eats your lunch. I think it's very important to, when we're looking at, for instance, I'm going to go back to the markets here. I guess most people are market orientated, but for instance, right at this point in time, the latest sort of iteration of aren't I so smart? Here's a new system. It's very, very clever indeed. Is factor investing. Now, I'm not a big fan of factor investing. It has worked up to a point. I'm sure folks at a variety of long-short funds who we shan't mention, have had outcomes that they would rather not have. Equity long-short based upon factors, based upon style. But in fact, the thing about machine learning is machine learning doesn't require you to generate a style. You simply ask it the right question. It will give you an answer. And I think it's very dangerous the way in which the markets are designed now, that people say, I'm passively involved without realizing that they have this massive liquidity and basis risk to the underlying. Or they might say, well, I have no net risk because I'm factor investing and I'm net neutral. And you go, yeah, you're massive correlation risk. Now, I know people know that, but really this has really gone to a certain extent now that we're starting to see the really bad outcomes now from that sort of approach.
And so with that, then, if one is an asset allocator, so for example, if I have, my portfolio, which let's say in the end is going to be, beyond the marketing, let's say it's just a 60-40 portfolio. What would you suggest I do?
I think that the reason why people use indices generally is because it's cheap. But there's another reason. They use indices because it's easy and it's less thought. They use indices because what they're saying is, well, like my 9-year-old daughter once said to me, you get what you get and you don't get upset, right? In other words, I'm in the markets. I'll take what the markets will give me, whatever the markets give me. That's got to be brilliant. But of course, as we all know, is your economic outcomes, your investment outcomes really relate more than anything else to you knowing what your appetite for risk is, and for you knowing how much you wish to decline downside. I think most people don't give that enough thought. I think if we were to see more, I don't mean better trained investors, I just think people thinking about more what they were trying to achieve with their savings, then they would also take very different decisions about how they would asset allocate them. This is why I think that this is the way forward. Tokenization added to this concept is ask people very simple questions. So, how much money would you like to earn? In other words, sort of, if you like, it's a knowledge of a real return that you're looking for, or even a nominal return. And then don't say, well, yeah, we'll just go in the markets, and if it gives it to you, it's great. And if it doesn't, it's not my fault. But you use machine learning algorithms to go and volatility, liquidity, adjust all your trades. And, the onset of certain other types of computation, these calculations will become very, very cheap and very, very widespread. So I think that's going to add to.
At the moment, when you speak to portfolio managers or asset allocators or financial advisors, they often do try to answer that question. So you say, look, I want 10% returns. Then they look at the back test of how the 60-40 is done over time. Then it's actually, to get that 10% returns, you kind of need to allocate 80 to equities and 20 to bonds, and you'll be able to achieve that higher return. Or alternatively, you need to add some leverage. You'll get those returns, but there's some possibility for larger loss. So there is an infrastructure around that already.
Yes, you are right. Of course it happens, but it mostly happens via your access to rather expensive experts.
Yeah.
What I'm saying is I think it'd be much more widespread to people who answer those questions. This is where elements of decentralized finance are going to be extremely useful. Although DeFi is different from broadening finance, but it's part of the infrastructure of it. I think we're going to get people who are going to approach how they invest in different ways. Now, you might think, well, that's very different from you saying there's a massive amount of uncertainty in all outcomes. How can you even suggest that there's a response? But my response to this is really we ought to be using more technology in order to help us make these decisions, and not less. even in an environment of difficult conditions, turbulence, and where the whole idea about this sort of star investment manager and the star fund management process is, I think that only exists insofar as fees don't just keep coming down. They get to a point where these people just won't be prepared they won't work because they're not getting paid enough. Now, I know that probably seems very unlikely when there's all this money out there and people are being paid, but I do think the democratization of finance is going to broaden and deepen much quicker than we imagine. Much, much quicker than we imagine. And it's going to be technology based. It's already happening, but it's going to be much broader.
Given your view of more uncertainty, I mean, can we say that, equities will have lower returns in the next, say, 10 years? Bonds will have lower returns in the next 10 years. Is that a worthwhile exercise to make those calls?
I honestly, I really have no idea. And you might think, well, what's the point? If you have no idea what you say, my strongest possible view is there's never been a better time to slow down, think very carefully about the risks that you're taking, and question them all, and have a plan B and a plan C and a plan D. Now, you may not be able to implement them. Part of the issue we were talking about before is that you can have all these different views and try and incorporate all the complexity in the world into what you're doing. But in fact, what you really need to do is think more and more carefully. This is a really difficult environment that is not getting better. And neither central banks nor politicians seem to have the answers to almost anything that's happening at the moment. I think there are fantastic opportunities. They will be in these newer technologies, but that's not to say that you should just rush into them. I think it was Buffett that said the single best indicator of the return on any investment was the price you originally paid. Right? So pay the wrong price, you're not making any money at all. And I think a lot of what we saw in the first half of this year was the fact that we had a rush in the second half of 2021 into inappropriate technologies and maybe some of the more elaborate claims from VC and involving the SPAC market that simply couldn't be maintained. But that is not a proper reflection of the uncertainty I think that we've got coming down the pipe. And it does relate to that simple number of in terms of demographics, is we simply are going to run out of taxpayers, or we're going to have a lot more people who are pensionable, who are not pensionable rather, who would just keep working. Is that a world that people are going to be very happy about? We're talking about more existential things here, but if you had said, or you and I, or anybody on this discussion had said 5 years ago, well, of course, the thing about the Chinese property market is it's all going to zero. We just go, well, that's ridiculous. That's like $17 trillion worth of assets. I don't know what you're talking about. And now all we read about is people setting up organizations not to pay their mortgages in China. I understand it's not unknown. You'd have thought that would be absolutely impossible. I'm sure it's actually very difficult, but people can talk about it. So that's another example of a huge asset class whose outcomes have been tremendously unexpected, but they really rather largely built on the assumptions of a very large cohort of older people trying to save for the future because they're worried about what their pension's going to look like, and they've misallocated their capital. And the risks that they couldn't have anticipated have arisen. And now what are they going to do? What
about buying volatility? I mean, you touched on that right at the beginning, where if I buy some kind of option or instrument that benefits from higher volatility, so bigger swings in markets, would that not be an attractive way to prepare for this uncertainty?
Well, honestly, it's very difficult to make money buying vol. I mean, I've tried it on numerous occasions. So it's usually much easier, depending on your time frame, to the sorts of volatilities that you would need to be long in order to really take advantage of this are 10, 20, 30-year volatilities. That's not where all the liquidity in the system is. Most volatility in the system that you can trade is, frankly, it's way less than a year. If you're lucky, it's a year. And most of the very long-term volatility you can buy that's actually explicitly vol is foreign exchange vol, which is, a very difficult way of making money, right? A very difficult way. So the way I look at it is, if you think we are going to a more turbulent world, not necessarily volatile world. Volatile can be good. You can trade volatility. It's very difficult to trade turbulence. One of the things that you will get is very large moves up in vol, and then very large moves down in vol. In other words, the uncertainty around all outcomes, including vol, will be higher. I think that's the environment that we are likely to be in for quite some time now. We already are seeing that. This is a very standard view of looking at the markets, but we already are seeing that. I think they call it front of book volatility in the equity market, which is, look at the price of how many contracts can you trade in the front contract, and how many contracts are there just behind where you're trying to trade bid offer. And I think that those levels are as low as they've ever been measured right now. So it doesn't look like the market's volatile, but try executing. I think it's the same in the underlying. Do they not say now that there are more ETFs than underlying?
Yeah,
I think so. Are there not like 3,000 less companies that exist now than existed 20 years ago? How many actual companies are there? There's been an enormous amount of concentration of risks, people swallowing up each other. That's just part of that's obviously just part of the process.
I mean, so Ken, what put trades on that benefit from like volatility, like vol or devol type trades?
Oh, not for anybody who can really make money in it. It may well be that. I think what it probably means is that if you're going to invest in somebody who's an equity long short person, I'd really rather be long. I'd invest in somebody who was buying and selling single stock versus single stock relative to them buying index versus index. Now, that might not make sense to other people, but for me, it makes a lot more sense, is that if you're going to get it right, and you're going to be really, really, you have to be more accurate with how you approach these markets. I think the idea of having a lot of aggregate risk is much more risky than you realize. Did I send you you said it, what have I think the question was, what have I learned from the markets? And I'm afraid I gave you 10 things, but they're all one thing. They're called the Mandelbrot 10, where there was a mathematician called Benoit Mandelbrot, who's the father of fractal mathematics and elements of chaos. And he wrote a fantastic book called The Misbehavior of Markets. Miss is in parentheses. So The Behavior of Markets by Benoit B. Mandelbrot. And in that, he notes 10 things. And for anybody who's been involved with the markets for any period of time, or anybody who's just interested right now, please buy the book. Look at Mandelbrot's 10 observations on markets, and you will shake your head and go, well, that is you'll never read anything better than that.
Yeah. No, I'll include that in the show notes as well, a link to that.
Yes.
Now, a related point on my questions around vol and so on is what do you view, and this is a discussion I've been having with lots of investors around the world, some of the smartest investors in the world, and this question is coming up, is like, what is the safe haven asset of our time now?
That is that is the perfect reflection of everything we've just been discussing. If we can't identify the safe haven asset, is there one? Now, you see where I'm coming from?
Yeah.
And now, yes, it may well subsequently be that you'd have wished you'd have done one thing relative to anything else. I would say the safest safe haven asset that you have, any asset, is to actually know what your preference for risk is. As an asset, that's your biggest asset. If you understand that you can't afford to take more risk than X, don't do it. But if you can, and you can measure that risk appropriately, yeah, by all means, knock yourself out. I'm funny feeling that most people are really not that aware of what their actual preference for risk is. Most people know what their preference for returns is, but not their preference for risk. And that in these markets, in this environment, I suppose the point I'm saying is, what part of the point I'm trying to make is not buy vol or here's a trade, do one touches in dollar yen, and or the dollar's the only answer, and I wouldn't touch 2-year notes. It's that practically all the different ways I have made and lost money over the years, I'm much less certain of any of them working in any specific environment now than I am at any other point. Yeah. And I think that's just worth. I hope that's worth sharing, because
it's sobering, comment, but very valid. And I think perhaps that is what we need. I suppose this sort of shift in mindset and recognition that we have to understand as you say, our preference for risk in a way that we haven't had before.
Yeah, and this could be a relatively short transition to I think this is very likely to be true. This is almost certainly going to be a very short transition to a new equilibrium, which will not feel like it did before. Now, not just that the numbers are a bit different, but that the actual environment will feel different. The way I give you a very specific example of that. How unlikely is it that governments around the world decide to change central bank mandates? If I'd asked that question 3 years ago, 4 years ago, you'd have gone, no, that's just banana. Yes, good thinking. That's not happening. Well, that's not where we are now at all. I would suggest that it's very unlikely that it happened in the States. Although let's see what happens over the next 2 or 3 quarters, given what's going on politically. But it's highly likely to happen, I'm afraid, much more likely to happen in the UK than at any point ever. Now, what's interesting is, I think, didn't one of the candidates say this morning they're worried that the markets are going to start thinking that the other candidate's an idiot or something? It was something along those lines. Right, pretty much. And I just thought, that's not going to end well.
Correct.
Now, so I do think that an adjustment of central bank mandates could happen. Now, that I would consider is still just part of an equilibrium flip, and that would definitely change equilibrium to a new equilibrium. Definitely, not just that they'd moved. Every central bank in the world had an implicit target, allegedly, of 2%. Not just that. Oh, that's suddenly now 3.5%. No, I don't mean that, because that's not interesting at all. But I do mean what happens if we in the UK, we have to solve for growth or employment like they do in the States. You see, or stability, right? That really changes where things are. They're also talking in the States now about how the dot plots are a bad idea.
Yeah,
I believe that they are the worst thing that the Fed ever did. I don't mean to step on, stand on the edge here of not having a view, because they reflect a degree of irrational certainty that the market has reflected in the way it's invested. So sometimes you can give the market too much information. I think central banks should allow there to be a certain degree of uncertainty and then allocate assets in a way that wasn't like a rigged game.
Yeah. And what one risk we haven't talked about, but I know you have views on, is career risk of traders and portfolio managers and asset custodians.
Sure.
What do you mean by career risk, and what's how do you define it?
Yeah, I suppose. I mean, there's always career risk. There's clearly the biggest career risk you ever take is if you ever break the rules wherever you work. You shouldn't ever do that. There was a lot of that going on in the 80s and 90s where people were pressing against the edge, and that was seen as how you were selected to do those sorts of roles, to be honest, sort of irrationally certain about everything. But I think the career risks I'm much more concerned about now are the risks that people are taking in their long-term hedges and the long-term investments, because it's very much not just in pensions, but in all long-term investments, where people conflate the idea that because something is for the long term, that it means that they don't need to do anything about their risks. It's more dangerous to fiddle with my risks, to adjust them, because if that doesn't go right, it's suddenly obvious that I've touched it and it went badly, and if I hadn't touched it, it would have been okay. I think that because of where we're headed in terms of in terms of challenges for pension fund returns, I think we need to really think an awful lot more about the alignment and the way in which the people who manage our long-term assets are compensated, and make sure that actually people are compensated to take risks where they're sensible ones. I have a very strong feeling, my personal view, something of my experience, is that people are getting away with benchmark thinking, and the rise of passive trading has enabled a very large number of people to say as well, it's nothing to do with me. The market does this and the market does that. And, I just have this particular index and that's where I'm supposed to be. I don't believe that that everybody's like that, but I believe that too many people are like that. And that the risk that it represents for let's face it, most pensioners are not very wealthy. And I think we should be thinking about what is the best way of managing their money in this environment. It's really, really important to consider that. If you're a person trading on a trading desk and you work at a hedge fund now, and you're taking proprietary risk, of course, it's just your name at that company. You're part of the franchise. All your risks are your own. You're on your own. Good luck to you, right? But if you're managing, pots of capital that are going to be distributed to people where they may get 10 or 15,000 pounds a year, whatever. It could be a much smaller number than that. Then really, I think that doesn't mean that you get away with just sitting around being bureaucratic all the time. I think it's a very, very important part of what happens in markets is that the people who are managing money for those less fortunate should take very seriously their responsibility to provide good risk-adjusted returns.
Absolutely, yeah. And now I did want to ask you some personal questions. I mean, you already touched on them already in some way. So one was, lessons you've learned over your career, or best investment advice you ever received. And it sounds like the Mandelbrot list was certainly one set of them.
To be honest, I learned that after I've been doing it for about 25 years. I wish the problem is, if I'd known them at the beginning, they wouldn't mean anything to me, and I probably wouldn't recognize them. But when I see them afterwards, and I go, oh yeah, that every single one of those. So that's a perfect reflection. Please, and I really would suggest that anybody who's interested should look them up, the Mandelbrot 10. But I would say, I suppose the thing that I have definitely learned is that you mostly make the best decisions when you're not in a hurry. Now, even when you're a market maker, of course, that's nonsense. you really you've got to get a hurry up, right? You have to react, and that's why it tends to be something that's great. You'll overtrade, you'll do all the things you shouldn't do. But I think when you're trying to just make money, or you're trying to really outperform, then you've always got time. Always remember, you've always got time. And the key variable is, you cannot make money if you're not in the game. Don't be in a hurry to take risk just because you've thought about it. And lots of people do that. I seem to remember, again, this is relatively recently, when I first saw this clip, there was a clip of a gentleman called Paul Tudor Jones. Now, just because he's a hedge fund legend doesn't mean he's a legend in all aspects of investment, but I've got to give him credit. He really is something of a legend. And his whole concept was, you've thought about something. How many units do you want to reflect? Well, 10 units. Okay, come back tomorrow. You come back tomorrow. How many minutes do you want to do that? Well, halve it. The next day, halve that, halve that. You come back 4 or 5 days later, you still have the same feeling. You're down to 1 unit. Okay, maybe you should start putting the trade on now. Now, I think if there's one thing that people need to learn, if you don't have to take risk, remember flat is a position, number one. But number two is don't be in a hurry to get too big. If you're right, you'll still be right tomorrow. And if you're wrong, it's much easier to get out of a small position.
Yeah, no, that's great advice. Yeah. No, that's excellent advice. Now, the other question I wanted to ask was, what advice would you give youngsters when they leave university? At the top of our conversation, you did mention, turn up, be consistent. That's certainly one which is helpful.
Yeah, it's very difficult. I'm going through this exact process of my son. The advice I gave him is whatever you do as much as you possibly can at college. Join as many societies as you can. Meet as many people as you can. Do as many things as you can. You never know where you're going to end up. I think the days of the milk ground and the way in which people, and maybe that's just university, the university approach, and most people, of course, don't necessarily do that. But if you are in the sort of university originated approach, the milk round doesn't really exist anymore. So you really have to spend a lot of time meeting a lot of people. And that's the only thing I would suggest that people do, is that I think I've worked at some of the best institutions in the world. Some I've liked, some I've liked less, some I've not liked. Not, in fact, maybe only one I've not liked. But the thing that made all the difference is the culture within the place. It wasn't, did the place have a great reputation? Was I an exact right fit? Did I work for exactly the right person? And I think the only way that you can ever really realize what it is that you're like is by meeting lots of people and then just trying to identify when you're with people that you really get on with. Because that is it's almost the key to success.
Yeah. No, it makes sense. Absolutely. Yeah. Totally.
Get help, because it's much easier to ask for help for people you get on with. It's much easier to, I don't mean PLU, I don't mean people who look like you. I just mean people who are like you. They have the same values that you don't necessarily need to like them. You just recognize that, there are people who can really, they've got the right spirit, if you like.
Yeah.
It's not religious or anything. It's something, you know what it's like.
I think I know what you're talking about. Yeah.
I can't quite put it into words. I'm sorry.
Yeah. Another question I wanted to ask you was, we're overwhelmed with information and, data and research and content. How do you filter, curate? I mean, how do you keep on top of things? Do you have an approach, a system?
I do. I definitely am on the iPad way too much for a start, but I try and compensate that for making sure that I'm seeing people a lot, making sure I'm going out to visit people, making sure that that the people that I meet are doing interesting things. I've tried to move not just my career, but the way I look at the world. I've tried to go back towards a scientific approach with scientists, and sort of not re-enter the world of academia. It's not quite like that, but things that I've really enjoyed throughout my whole life, I'm sort of emphasizing a bit more, and not just making everything about work. And and of course, when you've got children, that happens naturally. You've not got enough time for you. The danger is when the children get older, and that you can suddenly get caught in a rut, I would say. But when they're younger, obviously, you're just too busy to think about things like that. But generally speaking, I do sort of, it sounds terrible, but I do keep notes. That notes function in the iPad, the sort of yellow thing. Anything I write or any website, I'll write a little note about it. And then I'll find, probably once every 6 months, I'll just go down the last, honestly, it might be like 500 of them, and I'll go through them and go, oh yeah, I'd forgotten about that. I was really interested. And it just helps me to just really try and connect up all the interesting things that are going on at the moment, or that I have thought in the past. So it's not living in the past. It's just reminding yourself of the things that you found interesting.
Yeah,
I try and do that all the time. It's just, I think it's hopefully it's the way to avoid all sorts of, brain deterioration as you get older. I don't play chess, and I don't do anything like that. I don't play video games, but I do try and read a lot. And
actually, on reading, another question I actually ask all my guests: what are some of the books that have influenced you the most?
Yeah, when you tend to read something like the FT or maybe anything that could be remotely related to finance, people tend to put, books like How I Became a Legend, and the book of Great Decisions I Have Made. I don't read, for what it's worth, I don't read those sorts of books at all. So probably the single book that made the biggest difference on me, really surprised me, because I think I read it when I was a relatively young man and a market maker at JPMorgan trading treasuries. So you can imagine, I wasn't really thinking about very much apart from where the 2-unit was. But there was a book that really affected me, even though that was all that was on my mind. And it's called The Man Who Mistook His Wife for a Hat by Oliver Sacks. And psychiatrist. Yes, it's a book of him describing a variety of patients and their conditions, why they arose, what their conditions were, and how it affected their lives. And it does sound very wishy-washy, but I really think that's a fantastic book. My favorite story in it, for what it's worth, is called Witty Ticky Ray. I can't even talk to you about it. I'll probably start blubbing. I can't even talk to you. Witty Ticky Ray.
Okay, I'll read the book. And now, finally, if people wanted to follow you or reach out to you, what's the best way for them to do that?
Well, fortunately, I'm not really into social media, okay. But I do post sometimes some things on Macro Hive, and occasionally people ask me to write things for them, things like that. But I'm afraid I don't have a Twitter, Instagram, TikTok, other dancing videos. I don't.
Okay, no worries. Like, if people can just reach out to me, and then
if anyone wishes to contact me on email, I'm very happy to say hello. Yeah, very happy to say hello.
And with that, I mean, we've had a fantastic conversation. I think I'm sure we could have gone on for longer, but this has been really, really good. And thanks again for coming on the show.
It's my pleasure. My pleasure.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or if you listen to podcasts, leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.